The conflict in the Middle East continues, and its impact on China's world factory has been far greater than anticipated. Recently, several authoritative organizations have analyzed that the raw material supply chain and high-end manufacturing chain in Chinese factories are facing the risk of a breakdown. Although China's power system mainly relies on coal and can maintain basic electricity stability in key fields like petrochemicals, synthetic fibers, and semiconductors, it still heavily depends on oil and liquefied natural gas from the Middle East. When energy transport is disrupted, the gap between electricity supply and manufacturing materials will quickly emerge, causing a chain reaction in businesses. Chinese automaker BYD has stated that the cost of each vehicle in the second quarter is expected to rise by 3,000 to 5,000 RMB due to the increase in prices for electrolyte solvents and lithium battery separator-related chemicals. The world's largest electric vehicle manufacturer, BYD, has recently seen a significant drop in sales, attracting market attention. Multiple media outlets have reported that BYD's EV sales in February 2026 dropped 41.1% year-on-year, selling only about 190,000 units. This marks BYD's sixth consecutive month of declining sales, and it also recorded the largest year-on-year drop since the pandemic in 2020. From a market structure perspective, BYD's domestic sales in China plummeted by 65%, which became the main drag on overall performance. Despite overseas sales surpassing domestic sales for the first time, the overall scale is still inefficient to offset the impact of the sharp decline in domestic demand. Data from Reuters and Bloomberg show that BYD's global sales fell by about 35.8% year-on-year in the first 2 months of this year, with the decline clearly exceeding the impact of seasonal factors like the Chinese New Year. At the same time, concerns about BYD's production capacity utilization rate are growing. A user on X pointed out that BYD's production capacity utilization may be less than 50%, noting that sales have fallen by about 36% year-on-year over the past 2 months. This comment quickly sparked heated discussion. In response, Elon Musk replied on X, "That's tough sledding. Factories do great above 80% capacity, marginal at 60%, and mega pain below 50%. This comment was widely quoted by US media. Additionally, according to Dataforce, BYD's market share in Europe has also declined. Hybrid models have dropped to around 15%, and pure electric vehicles have fallen to about 12%. Although BYD is still the global leader in electric vehicle sales, the continuous decline in sales over several months shows that competition is intensifying rapidly. The company has announced plans to introduce disruptive technologies, but it has not yet publicly responded to Musk's comments. Senior analysts point out that China's electric vehicle industry is highly dependent on government subsidies and policy support. Once market demand slows or subsidies decline, problems quickly surface. Due to the ongoing economic and market deterioration in China, BYD's sales strategy this year was originally focused on breakthroughs in Europe, the Middle East, and Latin America. However, in January, China lost its key stronghold in Latin America, Venezuela. Then, in February, the war in Iran flared up, completely disrupting BYD's global strategy. The industry generally believes that the Chinese EV market, led by BYD, is facing dual pressure from fierce price wars and slowing demand. Now, with a significant rise in costs and supply chain disruptions, it's like adding insult to injury. Whether BYD can survive this year has become a major question. Let's take a look at a few other major companies. Contemporary Amperex Technology, CATL, has adjusted its export routes to Europe, and there are reports of plans for battery recycling and material closed-loop strategies. On March 24th, CATL saw large-scale sell-offs on the Hong Kong Stock Exchange, with a trading volume of 180,800 shares at a price of 645 Hong Kong dollars, involving a total of 116.6 million Hong Kong dollars. The stock price dropped by nearly 2.6%. Industry insiders suggest this could be a warning that the company's stock price is about to plummet due to the impact of the Middle East situation. Meanwhile, Huawei is said to have implemented price protection measures for some of its products. TSMC is facing pressure in advanced manufacturing material supply, and Xiaomi has issued warnings about some products being out of stock due to raw material shortages. Industry analysts believe the most concerning issue right now goes beyond the Middle East. The deeper impact on China's manufacturing industry is becoming a major concern. Rhodium Group recently issued a warning in a brief analysis. If the Strait of Hormuz is blocked for more than 30 days, the risks facing China's manufacturing sector will not just be about profit compression and companies complaining, but could evolve into a substantial contraction of production capacity. This means that some factories may not just earn less, but might be forced to halt production entirely. Some production lines won't just see thinner profits, but might not even receive the raw materials they need, forcing them to stop operations. On the surface, many factories still have their buildings, equipment, and workers, but the key raw materials, chemical intermediaries, and energy inputs that sustain operations are slowly being choked off. After comprehensive analysis, we can see that the real danger of the crisis comes from several aspects. First, the shortage of naphtha has become the most elusive yet highly destructive invisible killer for the industry chain. While naphtha may not be as eye-catching as crude oil, it is actually one of the most basic raw materials in the petrochemical industry. From plastics, resins, and solvents to electronic components, automotive insulation materials, and optical processing chemicals, many of these products trace their origins back to naphtha. It doesn't immediately plunge factories into darkness like power outages, nor does it appear directly in news footages like port blockages. However, once naphtha is in short supply, it disrupts the entire industry chain, starting with the most basic chemical materials. In the electronics manufacturing and semiconductor industries, naphtha derivatives are far more important than most people realize. Take epoxy resin as an example. It is a key material for PCB substrates, packing materials, and insulation coatings. The upstream of epoxy resin is closely linked to petrochemical products like phenol and acetone. When naphtha supply tightens, the prices of upstream raw materials will skyrocket, which will ultimately reflect in the overall manufacturing cost in the electronics sector. For a seemingly insignificant circuit board, the cost increase may only be a few dollars, but for a factory that ships hundreds of thousands or even millions of units each month, this becomes a significant blow that can change the profit margins on orders. What's more troublesome is that many orders in the electronics industry are locked in at fixed prices. When raw material costs suddenly rise, businesses may not be able to immediately pass the cost on to customers, and they have to absorb it themselves. Electronic parts companies in East and South China are the first to feel this pressure. Many of these businesses are already caught in the crossfire of price wars and weakening demand, with very thin profit margins. Now, with a sudden surge in chemical material costs, it's like adding insult to injury. Some PCB suppliers have started notifying overseas customers of price adjustments, while others have chosen to delay deliveries to buy more time. To the outside world, this may seem like a price adjustment letter, but within the factory, it often means the procurement department has to recalculate costs overnight, the finance department must reassess cash flow, and the sales department has to renegotiate with customers, risking the loss of clients. In addition to resin materials, the supply risk for engineering plastics is also severe. Special plastics like polycarbonate, polyamide, and PCABS are widely used in electronic product housings, connectors, household appliance parts, automotive interior components, and electric vehicle insulation structures. These materials may not seem as high-tech as chips, but they're indispensable in high-end manufacturing. Without them, mobile phones can't have decent cases. EVs can't produce qualified insulation parts, and medical devices can't meet precision and durability standards. These materials rely heavily on petrochemical supplies from the Gulf region. Once transportation is disrupted and cargo ships are unable to dock smoothly, downstream factories will quickly face a dilemma of having orders but no materials. The scariest part of this situation is that many companies don't actually have high stock levels. In recent years, due to overall economic instability and increased financial pressure, many factories have implemented a lean inventory and just-in-time procurement. This reduces storage costs and frees up cash flow. Normally, this is seen as fine-tuned management, but when faced with supply chain disruptions, it becomes a fatal weakness. Many electronic and automotive part suppliers only have enough stock to sustain production for 2 or 3 weeks. At first, factories can cope by relying on inventory, but after about 10 days, issues like a shortage of a certain plastic, a missing resin, or a delay in the arrival of solvents will start to surface. The production line doesn't stop entirely, but certain parts are lacking here and there, eventually leading to a sharp decline in overall efficiency. This kind of sporadic shortage is more torturous than a complete shutdown because it leaves the factory in a perpetual state of wait and see and holding on. Looking further down the chain, sectors like precision cleaning, optical components, and semiconductor packaging are also highly dependent on high-purity isopropyl alcohol, special monomers, and chemical solvents. The quantities needed may not be high, but their quality requirements are extremely high, and the space for substitutes is minimal. For example, in optical lens production, the purity of the cleaning process is extremely strict. Even slight impurities can affect coating quality and the final imaging results. Semiconductor packaging is similar. It's not as simple as finding just any chemical to substitute. This means that if there are delays in the supply chain, companies find it hard to quickly locate substitutes with the same quality. The ultimate result isn't just a slight increase in cost, but a complete disruption in delivery times, and a loss of trust in the supplier. Imagine a factory originally responsible for supplying parts for smartphone camera modules. If the delivery of high-purity solvents is delayed by 3 weeks, although the factory still has power and workers are still clocking in, the key production processes can't move forward. Brands don't wait for you. Once the order is delayed, it could be transferred to other countries or suppliers. This is the harsh reality of high-end manufacturing. On the surface, it's about technology, but in reality, it's about the stability of the supply chain. A deeper issue is the discount advantage that Chinese manufacturing relied on to maintain its competitiveness. This advantage is rapidly disappearing. Since 2023, China has been using shadow tankers and other illicit channels to absorb sanctioned Iranian crude oil, benefiting from procurement costs much lower than international market prices. This geopolitical discount has been an invisible subsidy for China's manufacturing sector. It's not explicitly written into financial statements or publicly announced as a state support policy, but it has effectively reduced costs in chemicals, transportation, power generation, and the entire industrial system. When real estate is sluggish, domestic demand weak, and export competition intensifies, this energy discount has been a key reason many businesses could still maintain price advantages. However, once the conflict escalates and supplies are disrupted, this discount evaporates instantly. Chinese companies are forced to return to the international spot market, competing with buyers in Europe and other parts of Asia for the same supplies, pushing procurement prices up to international levels. This isn't just a slight increase in oil prices, it's a complete reevaluation of the entire manufacturing cost system. After energy prices rise, the first to be affected are chemical raw materials, followed by logistics, industrial electricity, steam, and heating costs, ultimately leading to higher prices for end products. This is what's known as cost-push inflation. It's not because the market is too hot or demand is too strong, but because if you don't raise prices, you can't survive. This kind of inflation is particularly harmful to China because one of the biggest issues in the current Chinese economy is insufficient demand. If demand were strong, businesses could pass on rising costs to consumers. But in a context where consumer spending is weak and price competition is fierce, many businesses, even with rising costs, are hesitant to raise prices. Instead, they're forced to compress profits, reduce shifts, delay investments, and even proactively cut back on production capacity. For industries like EVs, photovoltaic components, and energy storage batteries, which are already caught in fierce price wars, this situation is even worse. When energy and chemical raw materials rise again, businesses may appear to be pushing for more sales, but in reality, each sale brings them closer to the edge of losses. Furthermore, this impact also exposes the inherent fragility of the so-called fortress economy. In recent years, Beijing has emphasized improving food self-sufficiency, energy security, and the domestic production of key technologies, hoping to build an economic system that can function independently even under external sanctions. From a propaganda standpoint, this seems like a solid fortress. China has vast coal reserves, a complete industrial structure, and a large domestic market, which theoretically should be able to withstand external shocks. But this crisis has revealed a harsh reality. While coal can keep the lights on and maintain basic electricity grids, it may not be enough to maintain the supply of raw materials needed for precision industries. In other words, just because the lights are on doesn't mean factories can operate normally. For many precision manufacturing companies, what really matters is not whether there's electricity, but whether they have qualified specialty gases, solvents, resins, engineered plastics, and chemical intermediates. The semiconductor industry relies on high-purity gases and special chemicals. Synthetic fibers depend on imported gas and oil, and precision instruments and high-performance materials are inseparable from global supply chains. These aren't problems that can be solved by burning more coal. Coal addresses basic energy needs, but cannot solve the issues of globalized, refined supply networks and high-end industries. It's like having enough food and drinking water at home. You won't go hungry, but once you lack medicine, nutrients, and necessary parts, you can't maintain a normal life. China's industrial system is similar. It's large and has strong basic capabilities, but as it moves into high-end manufacturing, it becomes more dependent on global collaboration. This is why a conflict far away in the Middle East can quickly affect a series of industries in China, including chemicals, electronics, automobiles, photovoltaics, and medical devices. From this perspective, the so-called fortress economy looks more like a defensive idea that works under certain conditions, rather than a true ability to detach from the global energy supply system. Finally, all of these issues combined create a truly concerning perfect storm. On one hand, the real estate market continues to slump, local government finances are under heavy pressure, and consumer confidence is low. These long-standing issues remain unresolved. On the other hand, the three new industries, electric vehicles, lithium batteries, and solar energy, though they're growing rapidly, are still insufficient to fill in the gaps left by the slowdown in traditional growth engines. Now, the external shock of energy and chemical supply chains is like a heavy stone added to an already strained economic system. What's even more noteworthy is that this crisis will not only affect corporate profits, but also influence overall macroeconomic expectations. When companies find that raw materials are unstable, energy costs are rising, and orders are hard to secure, the most natural response is to reduce expansion, delay hiring, and cut investments. Once employee incomes and employment expectations weaken, consumer spending will further contract. After that, companies will hesitate even more to invest, creating a new vicious cycle. In this sense, the energy shock is not just an issue of oil and gas prices, but it could penetrate the entire economic cycle, from factories all the way down to urban employment, household incomes, and market confidence. Furthermore, what's truly alarming is not a spike in oil prices once a week or a delay in raw material shipments, but the fact that China's manufacturing industry is moving from struggling to endure rising costs to a critical point where some production capacity starts to lose its meaning. Once the Strait of Hormuz is blocked for an extended period of time, companies will gradually move from price hikes, adjustments, and production cuts to shutting down production lines, laying off workers, and canceling investments. At that point, the issue won't just be a number on the balance sheet. It will be the machines turned off in real factories, empty workshops, and increasingly unachievable growth targets. This is the most crucial part of the Rhodium Group's warning. The Middle East crisis brings not just political turbulence, but a destructive test of the underlying resilience of China's manufacturing system.